Hello and welcome to the CIO Update. It's been an interesting week. On the one hand, we continue to have good economic news from many parts of the world, but secondly, we had a statement from Janet Yellen that's got the market more fearful about interest rate increases. So let me try and put some context around this. Firstly, that better macroeconomic news has come as quite a surprise to the markets. Remember, at the time of Brexit, people were fearful of a recession in Europe. Yet the European economic data has been much better than that. Secondly, if we look to Japan, even there, after some very weak data, things have started to turn around. So what was Janet Yellen doing when she said that maybe there is scope for increase in interest rates into the balance this year? Well, the good news is the US economy continues to come in better than expected on many data points. And this is leading the market to be less fearful of increases in interest rates. And Janet Yellen just pointed out the data is better, and it wouldn't come as a complete surprise the committee turned around and increased interest rates. In our view, that increase in interest rates could come as early as the meeting in September. We're not fearful for asset prices as a consequence of that increase in rates. If we've got reasonable growth, that leads to upgrades to corporate profit forecasts and generally markets in equities that continue to be supported by fundamentals. Our preference at the moment is to focus on the emerging markets, where valuations are considerably lower, where the US interest rate increase will be offset by many countries, such as Indonesia, cutting interest rates further from here, and countries such as India and China, where the macro news has been better of late. In the credit markets, certainly government bond markets will be challenged in the US by the increase in interest rates. And this increase has already been predicted in the curve with a sharp movement up in yields that we saw at the back end of last week. However, yields remain relatively low and could easily be accommodated in an economy that's growing at close to 2%. So our focus is on the credit markets, emerging market debt, which is still well supported by relatively high yields, and generally in other markets which still offer an uptick on the yield that you get from the US government. So in summary, there's a challenge of an increase in interest rates offset by good and reasonable global growth and asset markets in certain places that still offer some value, particularly in the emerging world.